everyone, in this video we will be looking at associates under IAS 28, investment in associates and joint ventures in a simple and exam-focused way. Associate is an entity over which the investor has significant influence but not control or joint control. It is neither a subsidiary nor a joint venture. What exactly is significant influence? It is the power to participate in, but not to control, the policy decisions. Main indicators are representing and the board of directors and shareholding of 20% to 50% of voting power. But remember, shareholding alone is not enough. It only indicates it is not an automatic rule to be an associate. Other indicators include representation on board of directors, participation in policy decisions, material transactions between investor and investee, exchange of management personnel, and provision of essential technical information. So, how do we account for the investment in associates and the statement of financial position? Using equity method. Remember, we don't consolidate, we use equity method. The initial recognition of the investment is recorded at cost. After acquisition, the carrying amount increases by investors' share of profit and decreases by the investors' share of losses and dividends received. Well, there is a tip. If there is impairment and losses, the investor recognizes its share of losses. The carrying amount can reduce to zero, but once it reaches zero, stop recognizing the losses unless the investor has legal or constructive obligations. Also, the investment must be tested for impairment under IAS 36. Well, it is not examinable, I guess. After increasing investment in associates by post-acquisition reserves, which include profits, dividends received, and losses, investment in associates will be reduced by impairment losses, parent share of unrealized profit if the parent is the seller, and parent share of excess depreciation on fair value adjustments. As for the accounting of statement of profit or loss and other comprehensive income, we take the parent's share of profit of associate less current year impairment loss for fair value adjustment less parent's share of unrealized profit if associate is the seller less parent's share of excess depreciation on fair value adjustment. The same way we account for associates' profit in consolidated statement of profit or loss, we also account associates' other comprehensive income in consolidated statement of profit or loss and other comprehensive income. That is, within consolidated other comprehensive income, the group should present its share of associates' other comprehensive income. Dividends received from the associate must be removed from the consolidated statement of profit or loss. Transactions and balances between associates and parent company are not eliminated from the consolidated financial statements because associates is not within the group. As for accounting for the unrealized profit in associate, if associate is the seller, debit share of associate's profit, that is P&L or retained earning, credit inventories and statement of financial position. If the associate is purchaser, debit cost of sales in P&L or retained earning, and credit investment and statement of financial position. So far, we have looked at consolidated financial statements and we use equity method for accounting in consolidated financial statements. However, in separate financial statements or non-consolidated financial statements, we have options. We can account for associates and joint ventures using cost method, equity method, fair value method. In separate financial statements, dividend received from an investment are recognized in profit or loss unless the equity method is used. And if the equity method has been used, then the dividend received reduces the carrying value of investment in associate. So here is a quick review. There are three methods to account for associates in separate financial statements and only one method to account for associates in consolidated financial statements. Under cost method, include only the dividend income received. You don't include addition to the investment of profit share or deduction of dividend received in investment. The same goes for fair value method. But for equity method, under separate financial statements and under consolidated financial statements, share of profit of associates is included in the investment and dividend received is deducted from the investment and not included as dividend income. The journal entry for share of associates profit and dividend received are as follows. You debit investment and credit P&L for the share of associates profit, and you debit bank and credit dividend income for cost method and fair value method, and you debit bank and credit investment for equity method. IAS 28 investment in associates and joint ventures. The disclosures are as follows. Financial statements of the associates that are used for equity accounting must be prepared up to the same reporting date as the investor's financial statements for consistency. And if that's not possible, the difference in reporting dates should be less than 3 months. Alright, that's all for this video. I hope this explanation was helpful. See you. There is a disclaimer